These deals never happen in a straight line, right? Like any good novel, they have their twists and turns. Management is best served by focusing on the business and allowing the bankers to take the burden of the deal to the extent possible away from the company. A deal is only signed when both parties perceive it to be a win-win or a lose-lose. We now have a very deep and vibrant private equity market with more than 200 funds from all parts of the world now investing in India. The best deals are done when both parties walk away from the table feeling that they pushed each other to the limit and they got the best that they could.
Before a company becomes a headline, before the IPO is oversubscribed, before valuation debates take over primetime television, there's a quieter moment, a room with a handful of people, and questions that don't have easy answers. Should we go public now or wait? Is this the right valuation or are we leaving something on the table? Is this partner the right one for the next decade? These are moments that don't make the news, but they shape everything that does. Because long before the markets react, before the first trade is placed, the real work has already happened. This is the world of investment banking. At a time when India is becoming one of the most important capital markets in the world, very few people understand the IB machinery that actually powers it. So today we'll be diving into the world of deal making, capital advisory, and how strategic transactions really shape businesses behind the scenes. Joining us is Ashish Ambwani, Managing Director at InCred Capital. Ashish brings over 18 years of experience in investment banking. He has been responsible for origination and execution of transactions totaling more than $5 billion across various sectors, with a focus on cross-border and domestic M&A. At InCred Capital, he currently is responsible for M&A and private equity into and for India clients and leads coverage for various sectors including consumption, digital, and manufacturing. He's worked on numerous transactions including Osam Dairy's sale to Dodla Dairy, Live Pure's capital raise from M&G Investments, Raymond Consumer Care's FMCG sale to Godrej Consumer, the IPO of Eat Horse Limited, to name a few. Ashish, welcome to Ask InCred.
Thank you so much. Pleasure to be here.
Perfect. So, you've spent about almost 18 years in investment banking. So why don't we just start by talking about how the investment banking landscape and capital markets has evolved in the last decade in India? And maybe how do we compare to the global peers out there?
Sure, that's an interesting question. I would say that the market has substantially deepened over the last decade and a half. If you take a step back and go to about 15 years ago, it was a market that had participation largely by the local domestic industrial houses and a few international companies that were looking to enter India in selected areas or selected sectors. But if you look at the landscape today, it's much more vibrant, much more deeper. You have every conceivable form of capital pool that is there globally, which has also found its way to India. To illustrate that point, we now have a very deep and vibrant private equity market with more than 200 funds from all parts of the world now investing in India. We have people beyond private equity. We have the global pension funds, global sovereign wealth capital. All of these were not there 15, 20 years ago, but they've all come in and they're now all actively looking at deals in India. So we've deepened the capital pools on the financial investor side. And we've also had every single strategic company of significance, if you think about globally, who was previously not in India. Either they're already in India now, or they're looking at India very closely to find a way to make their way into India. And we expect this journey to continue, right? If you go forward 10 years, you'll have logically a much more deep and vibrant capital market in India.
Interesting. And if I could just ask you, how do you think this overall market is split across globally, right, in terms of the deal volume or value that happens?
Sure.
If you could just throw some light on that.
Sure. So typically, give or take, global advisory M&A tends to be between $4 and $5 trillion a year. Mm-hmm. That's the current run rate that we are averaging at. Like everything else in life, the US capital markets are obviously the most deep, sophisticated, pool of capital and tend to occupy a good share of that market.
Interesting.
Whichever way you cut the averages, the US tends to do about 50 to 60% of
Wow.
that market, right?
Right.
And then you talk about the other pools of other segments of the market. You have the European geographies, which are the meaningful portion of the market. I would argue maybe 20-25% of the market. And then you have Asia. Asia, to your earlier question, was again a relatively insignificant part of the market, a decade and a half back, but that percentage is swinging sharply in favor of Asia year by year. China led the revolution. China has a very deep and sophisticated market and has had that for a decade plus. India over the last 5-7 years has played catch up. Now I would say between China, India and other parts of Asia, increasingly the percentages are inching in their favor every year. Typically between 20 and 25% of the global market now is Asia. India is starting to be a meaningful market within Asia. So it's typically China, India, Japan. These are the three markets of significance in Asia.
We were just talking earlier about the various kinds of, investors in this landscape. So you were talking about strategic investors and then financial sponsors. For our viewers, could you just help us understand the difference?
Right. So when we say strategic sponsor, we're really referring to a company that tends to more often than not be in one area of specialization. For example, typically a sector would be a good way to think about it. So I would use the example of a Pfizer. Pfizer is a global American major into the healthcare business. Basically, they make medical products and pharmaceuticals and vaccines. And Pfizer would do that business not just in the US, but increasingly as a multinational corporation, they would do that business in every other part of the world.
Right.
So when we say strategic investors in our parlance, we're really talking about corporations that tend to be in one area or one sector or one before they move to other geographies. So they're a meaningful and important part of the market. But other than them, the meaningful market participants tend to be financial investors. Financial investors, by their very nature, are the opposite of strategic investors. They bring in capital as their predominant form of expertise. They also bring in their knowledge of investing in various other parts of the world. But unlike strategic investors, they come with a finite timeline, right? Their money is basically coming into a particular area with the expectation of a return in a defined time frame, which tends to be between 5 and 7 years. Strategics, on the other hand, have an infinite hold period.
Wow.
So in theory, if I'm a strategic in pharmaceuticals and I decide to enter India, there is no conceivable reason for me to exit India for a long period of time.
Could you give me an example of both cases of deals that have happened in India, one with a strategic investor and one with a financial?
Sure, absolutely. So India has had examples of both and of all kinds. So I would just pick up an example of a strategic investor from the last year. So we had RBL Bank, which is a domestic financial services institution, a private sector bank. They decided, along with their board of directors, to sell control of the company. And Emirates NBD from the Middle East, as a strategic banking participant in that part of the world, came in and took control, i.e. greater than 51% of the bank, and they got RBI permission for that. So that's an example of a strategic deal.
Right.
Example of a financial sponsor deal could be several, but just to take an example, KKR last year sold a meaningful position in a pharmaceutical business, which was JBL Pharmaceuticals, and they sold it to Torrent. So Torrent was a pharmaceutical major from Ahmedabad, India, that acquired from a financial sponsor in KKR a position in a domestic formulation business. So what you can see from that is, in a given deal, it is highly likely or quite possible that you have a financial sponsor on one side of the trade and a strategic buyer on the other side of the trade.
Absolutely, I was just coming to that. Yeah.
And the reverse is also possible, right? You could have a strategic deciding that,
right,
there's a certain business of ours which we find non-core, or a certain geography of ours which we find non-core. They would be willing to sell that business or that piece of business. And it could so happen that the buyer on the other side could be a financial sponsor.
Interesting. So it's a very close-knit, I would say, like an ecosystem where, financial investors are always talking to these strategic investors.
Yes.
And these conversations happen over golf courses, I hear.
Not just golf courses. I think they happen over extended periods of time. I mean, that's essentially
Right.
what it is, right? I mean,
Right.
what you see in the headlines today is something that's been cooking under the hood
For a
for
long
between
time.
6, 12, 18 months in many cases.
Lovely. So, just coming back to India, which sectors do you think are really seeing strategic interest right now?
Sure.
And I believe the overall M&A value has possibly hit US dollar 80 billion in 2025.
That's right.
That's a big chunk of, that we're hoping is from India.
Sure. So the way to think about this is, look, India, the good part right now is it's a secular, broad-based action, right? So we have action across all areas of the economy,
Nice.
starting from infrastructure, financial services, consumer, healthcare, technology, manufacturing, right? If you go back in time, what you would observe is that typically the activity was not as broad-based. This comes back to the economy, right? When we were a per capita dollar economy of less than $500, $700, today we are about pushing $3,000.
Right.
The kind of things that are happening or the kind of activity that's happening is more basic, right? It tends to be as simple as consumer food, right? Because that's the first thing, or medicine, right? But as the economy deepens, individual sectors start deepening. You now have activity in discretionary consumption. You have activity in luxury, in consumer, for example, which was not the case earlier. Also, with the global geopolitical shifts and China plus one emerging as a meaningful activity, you now have a meaningful interest in manufacturing in India.
Nice.
So, a very sharp integration of India into the global supply chain for manufacturing is underway as we speak. We have secular activity across the board. From a financial sponsor perspective, more often than not, their investments in India tend to be in financial services, in consumer, in healthcare, be it pharmaceuticals or healthcare services, hospitals,
Okay.
but also in the mainstay of India, which is one of our primary export earners, which is the technology sector, right? The technology sector is a very meaningful part of the Indian economy, as we provide services on the IT and IT services side. So these are the areas where financial sponsors tend to invest. Now we are finding interesting developments in manufacturing because, as manufacturing becomes important and infrastructure continues to grow for India. So these are also areas where we're seeing activity.
Interesting. Could you please give some examples of manufacturing-oriented strategic investors who could be eyeing India in the coming years?
Right. So manufacturing by definition is a very diversified set of industries, right? So we could be talking about auto component, we could be talking about chemicals, we could be talking about packaging, we could be talking about various individual subspaces. So in each of these spaces, right, individual participants in that particular subspace are all eyeing the market, right?
Okay.
So for example, just to name a headline deal from the last couple of weeks, so we had a packaging business based out of India called SL Propack, EPL Limited.
Okay.
It's a listed company in the Indian markets, give or take $1 billion. We had Indorama from Thailand, who came in and took control of that business and combined it with another set of their businesses globally to create a regional packaging powerhouse that continues to be domiciled in India and continues to be traded on the Indian markets.
Wow.
So we see these activities not just in packaging, but we see it in various other subsectors of the manufacturing landscape.
That's interesting. I think these are the kind of things I'm sure are going to add value to our listeners today, because when we spoke about manufacturing, I largely thought about consumer goods and
Sure.
auto cars, obviously, but I think packaging. There are so many of these smaller,
That's right.
elements in the entire supply
That's
chain. Great. Now, I was thinking, let's move on to a little more of the action area in IB, because we all know that it starts with a conversation when we talk about billion-dollar deals. So why don't you take us inside the room and tell us, what does a high-stakes deal negotiation really look like? What does it entail? What happens behind those closed doors?
There are many things that I cannot say, but I'll try and address it to the extent I can. Look, so what we see in the headlines on a given day is typically something that's been under wraps and has been cooking for a while, right? And these deals never happen in a straight line, right? Like any good novel, they have their twists and turns. And no, any deal that gets announced probably went through a few deaths in the run-up period to that deal. That's the nature of the business. I think what tends to happen is, essentially it starts from relationships, right? People tend to do business with people that they know of or have regard for. So essentially in our profession, what we do is most of our time, the deal is the outcome, but it's really about, having spent a substantial amount of time with a particular client or with a particular investor for extended periods of time before they come to a stage where they may suggest or reveal that they may be considering divesting a certain piece of business or maybe interested in a particular asset. And that this conversation is happening, 12 months before, 18 months before you see the headlines.
Interesting.
From the time the idea is conceptualized, right? Either by a banker like me or by a suggestion by a particular client. From that process, there is a whole variety of stakeholders involved to get the deal to a stage where it's announced in the headlines of the Economic Times.
Interesting.
Right? And it covers various aspects, right? It covers preparation, which means a small team within the company, along with the banker, prepares for marketing that particular asset or that particular business in the best possible way to the whole wider world. It then spans interacting with a series of potential interested parties, right? Who could be strategics, who could be financial investors, as we spoke about. And then you have something called a term sheet, right? Which says, okay, provided everything stacks up, we could be interested in this business at these kind of terms, at this kind of price.
Right.
Everything that has happened up to that stage in marketing is then validated through the process of diligence, right? And diligence involves not just the company, but external agencies like the Big Four, including Big Four on the financial side and the tax side, as well as legal advisors, right? And all of this work happens over another 2-3 months, right? So, from door to door, it can take anywhere between 6 to 9 months or more to get these things done. And, and they all have their pushes and pulls and negotiations that happen.
And emotions running high?
100%. No matter how dispassionately one views, this as a financial transaction, it never is, right? Because there are human beings involved. In many cases, the founders of the business are involved, and they've spent maybe decades creating this business, right? So while they're very interested in the financial outcome, they are at some fundamental human level very interested in seeing that their business goes into a piece of hands or a set of hands that will grow the business, right? Irrespective of the financial outcome. Yeah. So there's a lot of emotions involved in these decisions.
Wow. I think recently I met a founder and, she was saying that, it's almost like giving away your baby, right? You're cutting the umbilical cord, but then you want to ensure that it's still thriving wherever it goes. But lovely. Thank you for that insight. Sure. But tell me, who really has the power in that room, right? Is it the founder or the investor or the banker?
Power shifts. That's the nature of the business, right? I guess at some fundamental level, when you start off and the asset is very attractive and, you're selling a marquee business, for example, the whole world is your oyster, right? Because everybody will call you from every part of the world saying, this is an excellent business. I'm really keen to get a piece of it. So at that point, perhaps the power rests with the seller or the banker representing the seller. But at the end of the day, every deal only happens with one person, right? So under a particular set of terms. So, by the time you get to the finish line, you've already whittled the field. You're typically in something called exclusivity, right? Which means that you've committed to the particular buyer that for a certain period of time, I will negotiate on these terms only with you. At that point in time, power again shifts. It becomes more of an equilibrium. And so power kind of shifts, right? Depending on how interesting the asset is, depending on how many suitors, depending on how good the diligence has panned out. But typically at the end of the day, it's a buyer, a seller, and a set of advisors on either side. No matter how long the process is taken, 6 months, 9 months, 18 months, right? A deal is only signed when both parties perceive it to be a win-win or a lose-lose. What I mean by that is, the best deals are done when both parties walk away from the table feeling that,
they've got a fair
they pushed
deal,
each other to the limit and they got, the best that they could.
Amazing. So tell me, in this equation, do you think there is any one particular misconception that CEOs or founders have about approaching an investment banker? If you would want to kind of guide anyone who's looking for a banker right now, the floor is yours.
Right. So I think people tend to make decisions on a variety of parameters, right? One of which is cost. And cost is obviously an important parameter because the way our industry works is, we basically take a percentage of the entire deal consideration, which in itself looks like a meaningful percentage for somebody who has spent a decade creating the business. But I think what people tend to misunderestimate is that, what they should focus on is the banker's ability to shepherd that process while allowing the management or the company to still keep their time running on the business. What I mean by that is management is best served by focusing on the business and allowing the bankers to take the burden of the deal to the extent possible away from the company, right?
Right.
Because there is no value in doing all that work for 6 months, 9 months, 12 months, and then the business itself underperforms in that period and you have no deal, right? So the best bankers try to limit the amount of effort on the company's part while taking up the massive burden of managing the deal through. And in return, the fee is just it's a relatively small percentage in the context of the deal. What really matters is, can the banker step up and guide the process in the most efficient manner from a time perspective and from a bandwidth management perspective, right? And if you can find those traits in your banker, right, that's something I would urge all founders to think about, not just the headline credential or the headline cost equation.
Ashish, tell us something more about, what structural changes are you seeing in how Indian corporates are approaching inorganic growth today?
Yeah, I would say that the acceptance or the willingness to explore inorganic growth is the first thing that's fundamentally shifted, right? If you, again, took a step back a decade or so ago, if you spoke to 1,000 companies out there, many of them would never have bought a business in their life or sold a business in their life. And their understanding of the M&A process or, what it represents was very low, right? What's happened is, as the economy has deepened with all the participation of capital markets and capital pools coming in from all parts of the world, there is first of all fundamentally an increasing acceptance to explore M&A, right? And this is coming essentially from the knowledge or the recognition of a few basic variables. Competitiveness has gone up across all sectors, right? Conversely, securing growth or getting the growth that you used to get in the past is harder and harder, right? And there is a very volatile world we're living in, geopolitics and otherwise, right? Supply chains are in flux, inflation is behaving a certain way, you have tariffs, etc., etc. So people are recognizing that there are many more variables at play, and a business that was growing at a certain cadence, it's getting harder and harder to kind of keep up that growth, right? Yeah. And therefore, there's an acceptance or a willingness to see whether they can kind of administer the same rate of growth by exploring inorganic ways of growth, right? And that could be, by buying another business, by buying a certain technology or a certain capability on the manufacturing side that they did not have. Also, fundamentally now, the business landscape and businesses are more global. So they're willing to look at businesses outside of India as well, which was not necessarily the trend, right? So you have all of these confluence of factors, which has basically improved the level of, acceptance of M&A, the need for M&A, and more and more companies are participating in it. I think this is a seismic change that fundamentally has happened in the landscape.
Interesting. Also, I think when we were having a discussion on wealth management, and there was a recent news article, right, which said that a lot of the next gen actually do not want to continue with those businesses.
Absolutely.
I think that's a good business for you, right, as an investment banker.
Yeah, absolutely. I think what's happened is that typically Indian businesses were founded by first or second gen. They created these businesses over 20, 30, 40 years. But, the children, inevitably have tended to study in, marquee universities, be it in India or abroad,
Right.
have been exposed to different, growth sectors or different kind of growth vectors in their respective journeys. And inevitably, when they come back to participate in the family business, they identify either the need to disrupt that business by, growing it faster, or they discover their own interest or their own proclivity does not lie in that particular business.
Right.
And they see certain other opportunities that are more attractive, right? In which case, there is increasingly, the third gen or the second gen looking at ways to monetize pieces of the business or their entire business to redeploy into other opportunities they find more attractive.
So we've discussed a lot of the aspects, that go into making these transactions successful. But do you think there is any one overlooked metric or financial variable that often determines whether a deal succeeds or fails post-closing?
Sure. So you're absolutely right. I think what tends to happen is, you've gone through this really intense M&A process or fundraise process, as the case may be, for a period of 6, 9, 12 months, as we discussed. And, and then it's done and you think it's done, but that's just the start, right? I mean, it's the end of the banker's job or the advisor's job, but it's really the starting point for the creation of value, because, it's only when the deal closes that, value creation starts.
Right.
And I think it more than a financial metric or more than, any particular return on capital metric, the most important thing to achieve is to align the management team with the set of activities that you intend to undertake on day one, right? We all get caught up in doing the deal, but I think the smartest acquirers, the ones who create the most value, are the ones who, in the last few months before the deal closed, are the ones aligning their management teams, both of the company that they're buying or the business that they are, or the business that is going to manage that company that they're buying. Essentially, you need to align that management team, saying, this is my value creation journey.
Right.
We're closing this deal on XYZ date. From day one, this is what I want you guys to focus on. These are the priorities for the first 30, 60, 90, 100 days. And if more often than not, if that first 100 days starts off well, with the team being fully aligned, the value creation journey over 3, 5, 7 years tends to be successful. But if the first, the first set of 100 or 2, 3 months are not aligned, it becomes a little bit harder to kind of, recover the full potential of the deal.
That's interesting, right? So that means like your responsibility doesn't really end after the deal closure, because I'm assuming that even the credibility of the banker could come under question if the success doesn't come through.
Yes, I think as bankers, we're obviously incentivized with just the outcome of, the deal happening or closing in a particular timeline. But I think you're right. As journeys compound over decades, people do tend to associate, even this action of, how well prepared was the banker, was the management team for the business, as something associated, as a mark of credibility for the banker that originally, brought the deal to the table.
Okay, now let's come to, what's happening today in the world, right? The complete chaos, volatility, geopolitical shifts. I think we were, till last year only thinking that we are dealing with tariffs, but now there's a full-blown war.
Sure.
How does this impact deal making? And let's talk about only the India context in this case.
Sure.
How has it impacted the scene?
Sure. For any deal making to happen, right, one of the variables that's required is essentially predictability, right? If you're not able to predict, the next 6, 9, 12 months out, it is obviously hard. Taking the decision to make a deal, to go ahead and press the button on a deal, is obviously hard in the context of all the variables shifting in the world right now, including, the war that you just talked about. But I guess at some fundamental level, we are now in a world which is far more volatile. I would say over the last decade, particularly since COVID, the rate of change is exponential, right? Be it AI, be it geopolitics, be it tariffs, be it, wars all across the world, right? I think the larger corporates and the more sanguine corporates are kind of reestablishing a framework where, volatility is a norm. and one has to kind of look past the quarterly and the annual volatility and decide at the very core that, what is the long-term strategy, right? And if the strategy for the 5th year and the 10th year is not changing, more and more corporates will have to, kind of take these M&A calls looking past the quarter or the 6 months, right? And so it's obviously harder to do it, but I think that's the reality that's now starting to seep in.
As valuations are tightening globally, how do you think it's impacting, India's risk return profile compared to other emerging markets?
Right. So Indian valuations, not just now, but if you look back in the fullness of time over the last decade or so, Indian valuations tend to be premium, right? Which means they always are a certain number of turns of EBITDA higher than the rest of the world, and in most cases, higher than most of the other emerging markets. This tends to happen because India has a very long runway for growth, right? I mean, if you look at some of the other emerging markets, their runway for growth is perhaps a decade or so. In India, one can safely say that given the nature of the country, the population, where we are in our per capita GDP, where the density of management talent that we have, the journey for India is many, many decades of compounding ahead, right? So Indian valuations were expensive, and even after this correction, still remain relatively more expensive than the rest of the world. So I think that the decision to come into India is taken recognizing that, the risk reward is in favor of the long term, right? It's unlikely that one is coming into India with a trading sort of a 3-5 year view, because it's really hard to make the math work with that mindset. So that's just the general observation on India. Obviously, things are, the dollar rupee is a very important variable, not for a long-term strategic acquirer, but a very important variable for a financial investor, right? So if I'm a US domiciled fund and I'm bringing in dollars at 80 rupees and the dollar rupee turns to 100, when I take back the money, I'm taking back that many less dollars, right?
Oh God,
Which means that the rate of growth in the period I'm holding an investment in India has to be that much higher to cover the dollar. So obviously, when you have these extreme currency fluctuations for financial investors in particular, it's something that they really need to go back to the drawing board and make sure that, in the long run, they still believe the growth can overcome the currency fluctuation.
Right. Interesting. Yeah, I would have never thought about that.
Yeah.
To close our conversation, what do you think could be one defining financial services trend that you think could impact deal making in a big way?
Right. Well, the thing about deal making is it kind of adjusts to each macroeconomic shift, each trend, each activity. So the nature of deal making, deal making will always exist, but around those processes, can there be elements that change? Yes, there are. I would argue that in the face of this global AI super cycle that we are facing, there is an opportunity to make these processes more efficient, right? What that means is, we talked about deal making taking a long time. It does. But, some of those elements of the process, including the preparation phase, the benchmarking phase, and so on and so forth, and even the interaction phase, elements of AI can help make that more effective. So you can take a little bit of time, perhaps, out of the equation.
Right.
So that's something that we see happening, not just with us as advisors, but even with clients, right? They can also leverage AI to do a faster job or a quicker job or a more efficient job, and not suck up massive amounts of bandwidth. Having said that, some elements of deal making don't change. It starts with trust. The client has to trust the advisor's recommendation, has to trust the advisor individually as well, and has to trust the judgment. So those things don't change. Judgment still remains paramount, but AI can hopefully shrink time, bring some efficiency in.
Great. So more volume of deals.
In theory, it should imply that the same set of deal teams could produce more deals.
Yeah.
So in some sense, it's a good efficiency marker for all of us.
On that very optimistic note,
Sure.
thank you so much for joining us, Ashish, and we hope to have you again sometime.
Thank you so much. I really enjoyed interacting, and you have a very engaging style. It was a pleasure.
Thank you so much.